Okay, it looks like we've got a great crowd, Dr. Anderson. So let me begin our session by first of all saying good morning and welcoming all to our session today. My name is Todd Miller, and I am your host for today. Thank you for taking the time out to join us. I am TEC Canada's president and CEO, and I've had the privilege to work with many of you and leaders like yourselves over the last 10 years. And it's quite frankly been very inspirational for me and I would say transformational in terms of the experience that I've enjoyed with our members. Today's event is an exclusive one. It's available only to members. And it's so great to see so many members turning out today to join us and chairs. So let's get to it. We're here to discuss a topic that's relevant to all of us, the economic outlook for Q4 2022. And within that topic is the TEC Canada CEO Confidence Index for Q4 2022, which is a quarterly survey measuring the confidence of Canadian business leaders of small and medium-sized enterprises. And of course, that survey is conducted from, this one in particular, is conducted from September 2nd to September 26th. 2022, and of course it had 322 participants. Now we've included the most recent CEO Confidence Index and the latest Andersen report in the chat area. So you're welcome to download it and share it with share the reports with your teams and have conversation about the economy. Now, if you have questions, we really encourage you to put them in the chat box. I've got a few folks watching and monitoring the chat area, and we'll make sure that we get to those questions. And even if we don't, if time elapses and we can't get to the question, we'll be sure and make sure that Peter has an opportunity to answer all questions offline, and we'll send them to you. Now, let me tell you a bit about the man who reviews the data, provides the insights, and helps us index past CEO Confidence Index. He also delivers the Andersen Economic Report, as I've mentioned. He does that for us every single month. And members, you know that that's available through techcanada.com as well as in the Tech Canada app. So I encourage you to dig in and have a look at that. Both the Andersen Report and the CEO Confidence Index are great resources for our tech community. So, Dr. Peter Andersen, he's an independent consulting economist specializing in economic forecasting. He obtained his doctorate in economics from Harvard University. Early in his career, he was the assistant chief of the Bank of Canada's research department, where he advised the governor in the Bank of Canada on economic conditions and on economic outlooks. Dr. Andersen also spent several years with several major Bay Street investment dealer firms before founding Andersen Economic Research, Inc. He acts as a filter, separating the signals from the noise in order to provide clients with the useful information that they really need. So without further ado, I'm pleased to introduce Dr. Peter Andersen. Welcome, Peter. Thanks for joining us.
Hey, Todd. Thank you very much. And Todd, thank you for having me. It's such an honor to work for TEC. I want to give a shout out to Larry Burke, who was the person who introduced me to TEC way back when. And for everyone out there, I just want to tell you how important this survey is. Because as Todd said, we're getting the mainstream view from the small and medium-sized business community. And that is so important for the economy. This is where the key decisions are made. And this is really a key driver. So thank you very much for responding to this survey. And to have 322 respondents, that is huge. Other surveys don't come close to matching this. And Todd, our survey is so timely. You can see when we closed it off. Colton closed it off just at the end of September. So here we are. We're just weeks away from when that close-off date was, and this is really fresh information, which is what we want because things are changing so quickly. We really want information that is timely. And so much of the economic indicators that we get from Statistics Canada, they're way behind. They're still, they are maybe a month or 2 months old. Anyway, thank you very much for your participation, everyone, in this survey. Now, what is it telling us? A couple of points of discussion. Just want to run through a couple of things that really come to the surface. First of all, this one is a red flag. It really shows that our membership, the top of mind concern is recession. It's what's keeping people awake at night. And what we have is pretty well everyone. 96% of our responses are really thinking about recession and is it coming? And if it's coming, how long will it last and how deep will it be? We have about 16% of our members who think it's a certainty. We have another 42% of our members who really give it a high probability. And then almost 40%, 38%, give it a moderate chance. But the point is, it's a top of mind issue, Todd. It's on everyone's mind, and people are losing sleep about this. Now, how does this compare with other surveys? Well, let's go back 6 months. 6 months ago, as I was saying, 96% now are worried. 30% were worried 6 months ago. Okay. 30% said they expected a recession. So 70% said, no, we're not really worried. So things have really changed, Todd, in just the last 6 months. Our survey shows that our members are giving a clear message that they think the economy is shaky. Okay, only 23% think the economy has improved over the last 12 months. Only 23%. It's a bit better in Alberta. So Todd, we've got just under half, Alberta think that things have changed to the better. But nationally, including Alberta, only 23% think that things are better. So there we go. That's kind of a top of mind red flag issue. Now, inflation. Is it going to cool down or not? We have kind of a split opinion on this. And strategy amongst our members is marked that way. About 45% of our members, 44%, think that inflation is going to cool down. A bit more time will cool down. And they're taking kind of aggressive measures. They're optimistic. About the same percentage don't think inflation is going to get any better. And they're playing defense. Okay. So half are playing offense, half are playing defense, depending on where they think inflation is going to go. In terms of our individual members and their pricing decisions, we've got about 2/3 of our members, Todd, who think they'll be raising prices for their goods, their products, their services over the next year. 2/3 of our people say they're going to be raising prices. Now, how many do you think expect to lower their prices for goods or services? Only 5%. Okay, so that's a message that's out there. If only 5% are thinking of adjusting prices downwards in order to protect sales, protect their business activity, it doesn't really make you feel too optimistic overall for the economy in terms of what inflation is going to look like. Now, in terms of profitability, it's interesting here because the costs are now an issue for our members. And we're getting a kind of an indication from you, our members, that profitability isn't quite as robust as it has been in previous surveys. 35% of our members think that profitability will be flat, and 30% say down. So add that together, 35 plus 30, that's 65% a clear majority of our members are saying flat to down when it comes to profitability. So I think that's something to pay attention to. Everybody is going to be thinking in terms of how can we maintain and protect our profitability.
Yeah, it's interesting, Dr. Andersen, because in that regard, as you think about raising prices, which many of our members are talking about doing, and yet obviously there's some erosion of profitability that is not keeping up with simply raising prices. Is that a fair comment?
It is a fair comment, certainly is. Now, what we're hearing, Todd, from members is that to some extent, and perhaps a large extent, the cost pressure is being passed on to customers at this point. I guess there's some resistance, and our surveys show that in Ontario, there is some resistance from customers to passing on costs in the form of higher prices. There's some resistance, but for the most part, these costs, they're being passed on. There's an attempt to pass them on, but it's not perfect because profitability is just, not quite as stable and as solid as it used to be. Anyway, inflation and cost pressures, that's really been looked at by the Bank of Canada. The Bank of Canada is going to be in the news. It's going to be in the news tomorrow. Tomorrow is the 26th. It's an interest rate announcement date by the Bank of Canada. And our members are saying that interest rates are really an issue. We have 40% of our members saying that interest rates are already hurting. 40%, that's a big percentage, Todd. 40% say interest rates, they're hurting. They're negative already. And another 37% say that if interest rates go up anymore, and think about tomorrow in terms of anymore, hey, that's 40% and 37. We're almost 80% of our membership saying interest rates are hurting or will hurt very soon before the end of the year. So far so good with the banks. The banks are still friendly, Todd, which is kind of interesting because, rates are going up, but banks haven't yet begun to tighten up on the small print. In other words, the terms and conditions. An example would be collateral. How much collateral do you have to come up with? And do you have to come up with more? And how about your line of credit? Are you going to be able to maintain that line of credit? And how about a risk spread off the business prime lending rate? Will the banks want to increase that a bit, a bigger spread on top of what their prime lending rate is? Well, right now, almost 60% of our members say, that's okay. We're not having problems with the small print, with the terms and conditions at which we're getting bank loans. However, there's a big but here. Some of our members, just under 30%, say, yeah, we are starting to see the banks becoming a little bit harder to deal with. And especially in Alberta, just under 40% of our members in Alberta say, look, our banker's not quite as friendly. He's not inviting us out to lunch as much. He's not taking us out to play golf. He wants us to come into the office and talk about some serious details on our business relationship. The other thing I'd mention, Todd, is in terms of liquidity and in terms of, to use a phrase, a credit crunch, one of the indicators of a credit crunch is the yield curve. Now, this gets a little bit wonky. It gets a little bit into the weeds of being technical. But basically, this is the story. When short-term rates are higher than long-term rates, lenders don't like it. they lose money because they get their money short term and they lend it out long term. And if they're getting it short term at a higher rate than they're lending it out long term, it means that given time, you do have the kind of tightening of credit that can bring on a recession. So right now, I'll give you the numbers for the United States, which are kind of the go-to numbers on this subject. Right now, the 10-year US government bond yield is 4.07%. And the 1-year government bond yield is 4.56%. Okay, so that's a noticeable gap. And Todd, I'm going to go back to 1955 because ever since 1955, every recession has been preceded by an upside down inverted yield curve. 1955. It's a long time ago, Todd.
Yeah,
Do
you're
you remember?
no, I'm sorry, you're putting me out of the radar, Peter. That's before my time.
Who won the Stanley Cup in 1955, Todd?
Well, you see, that's kind of like a trick question because I've already done the research, right?
Okay, there you go. So, I guess what I'd say is that the banks are still being friendly, ... but be careful, because it very well could be that credit conditions are going to get tighter as we move ahead. And finally, in terms of labor market strategies, one of the things that we really see everywhere, Todd, labor shortages. You know, in restaurants, you have to line up at the counter to put your order in. You know, you don't have a waiter or waitress show up at your table with a menu anymore. You've got to do the ordering, and then if you're lucky, somebody will bring the food out to you. But job shortages across the board and everywhere. So how are people dealing with this? Well, there's two ways that our TEC members are doing it. One of them is financial and one of them is non-financial. And the obvious way in terms of financial is compensation increases. You know, the hiring bonuses and the retention bonuses, but also increases in straight pay. You know, what I'm hearing in some cases is that $15 an hour, hey, forget about it. It's now $20 an hour. So, you know, we have this job market pressure, and one of the responses, compensation increases. Now, the problem is there's a feedback on that, because as compensation is more pricey, it feeds into pricing. And that means more pressure on wages to increase. And the Bank of Canada is watching. So where does it all end when it comes to interest rates and what the bank does and what we end up with? In terms of non-financial, remote working is definitely on the table. Remote working in terms of how people respond to this basic shortage of workers. And then we have operational processes. People are changing, Todd, how their businesses work so they can get along without having as many employees. Now, that's still in the early stages. Automation is definitely something that our members are talking about. In terms of possible layoffs, this is something that's really interesting to me, because our members are basically saying that with higher costs of labor, salaries, we're not really thinking about layoffs. Just only, you know, a minuscule number of responses say that they would consider a layoff as you go ahead. So this is different from previous business cycles. Previous business cycles, we would have layoffs, Todd. And this time around, because employers have found it so difficult to get workers, they're not going to be quick to press the layoff button. And that's something that our members are definitely talking about. So those are those are some of my points of discussion, Todd. Those are some of my top
Those
of
are
mind
great.
issues.
Tremendous highlights, Dr. Anderson, and I know that that will probably invoke lots of dialogue and discussion from our members. Again, guys, I'd remind you, members, that if you've got questions, please put them in the chat box. And as I mentioned, I've got some folks that are monitoring the chat box, and we'll make sure that we are fed the appropriate questions and ask Dr. Anderson. And I know, Dr. Anderson, I think you've got a few slides you're going to share with us as well, right? So,
Right. Yeah, I do, Todd. Yeah. So Colton, fire up the slides and let's take a look at some of. I've got 5 slides, and I want to apologize because I initially told Allison and Colton I'd only have 3 slides, but hey, Todd, I can't resist throwing in, 2 or 3 more.
I think we'll be fine with that, Dr. Anderson.
Okay. So I like to keep things simple, and this is one of the things that comes from the Bank of Canada. Tiff Macklem is the governor of the Bank of Canada. He made a speech to the Halifax Chamber of Commerce on October the 6th. And this was one of the things that he highlighted. He was saying that price increases are no longer just one-off things. Price increases are now spreading out to more and more goods and services. So this slide says that over half of the CPI basket, over half of the items in the consumer price index are now showing increases of more than 7%. You can see in the slide, you can see some of the other points of comparison. Okay. 75% of the basket showing increases of more than 3%. So Todd, the bottom line on this is it's hard to deal with. It looks like the spread is getting wider with each month because these percentages are now bigger than they were a month ago, according to the latest news. So if you or I were running the Bank of Canada, Todd, we would be worried about inflation, and we would want to do something about it. We'd want to deal with it. And the words that Tiff Macklem uses are important. And he's used the word front end loading. He wants to front end load his interest rate increases. So that means that, to me, we're not going to get any significant easing in the Bank of Canada putting on the interest rate brakes anytime soon. Now, the other thing that comes to real attention, the job vacancies. Thank you, Colton. You're right on the money there. Getting to that next slide. Thank you. Now, the problem is this data is always a little bit slow, Todd, in coming out. And that latest data point is really for August 1st. Okay. It's for August 1st. It comes from the payroll survey in Canada. But these job openings, everyone, it represents active recruiting. These are not just will-o'-the-wisp job openings that maybe yes, maybe no, we have a job opening. These are job openings that are being actively worked on to try and find people to fill them. And so I guess what I'd say is in terms of where we are, yes, you can see that come down a little bit, but go to the left-hand side of that diagram and you can see we are still exceptionally high. And what this is doing, it means that not only are price increases broadening out, but wage increases are now broadening out across all kinds of skill sets and across all kinds of industries. And one final comment here. How many unemployed people do we have in Canada? Well, the number of unemployed people basically matches the number of job openings. And these job openings, Todd, are across all industries. They're across all skill levels as well. So this is a real problem, and it's so different from previous business cycles. And, it's okay. It's a good question, Todd. Why are we worried about a recession when we have so many unfilled jobs, when we have so many companies that are working hard to fill positions. Anyway, one of the things that I would say is that this is putting upward pressure on wages, and wages are a big component of what goes into prices.
You know, Dr. Andersen, I know you're in your slides here, but there is a question that came up, and it's so appropriate to the slide that you have on the screen right now. Is it possible that we can actually drift into a recession and we don't have significant unemployment? Is that a possibility in your view?
No, I don't think so. I really think that the central banks, namely the Bank of Canada and the US Federal Reserve, they feel that they need to get unemployment higher by at least half a percentage point, if not a full percentage point. So that's their game plan. They're trying to affect expectations, what people have in their head with respect to where inflation will be 6 months, 12 months from now, and how do we protect ourselves against that. So no, I think that the game, and the problem, of course, Todd, with that game plan is that's on the demand side, isn't it? You know, higher interest rates get people to cool down their purchases, their spending. But if inflation is so much a supply side issue, will higher interest rates and higher unemployment really help us? Because remember, if we cut back on employment, doesn't that make the supply problem even greater? So it's tough. I'm kind of glad I'm not at the Bank of Canada anymore, because these are tough decisions, and it's such a different world than it's ever been before. Let me take a look at the next slide, which is labor productivity. And what this is, Todd, is this is a national measure. It's for the business sector. And what we're trying to measure is output per person hour. Physical output of goods and services per person hour of work used to produce that output. And this line is supposed to be going up, and it's not. You see, productivity increases are supposed to help offset cost pressure. It's a simple concept, but it's not working that way. Not at this point anyway. So it means that we really need higher interest rates because of this lack of help from productivity. The other thing is the Canadian dollar. Take a look at the Canadian dollar over the last couple of months. And as of this morning, we are still below 73 cents US, Todd, this morning. I looked at it just 5 minutes before we started our meeting. And what this is doing, this is adding to input costs, because so much of what goes into final sales is imported. And if we now have to pay more for a dollar's worth of US imports, well, then it's not good for inflation. It means a need for even higher interest rates because of that. So that's just those two things, productivity and the Canadian dollar, they're going the wrong way and making the Bank of Canada's job harder and making the Bank of Canada put in more in the way of rate increases. Anyway, the final slide I have is important for all of our members, because this is the prime lending rate of the chartered banks. And every time the Bank of Canada raises its policy rate, this pushes up the bank's prime lending rate. And this is what, Todd, we all borrow at. And we don't actually borrow exactly at that rate. We are given a spread on top of that rate, depending on our credit worthiness and the risk connected with the loan that we're seeking. And my feeling is we are going to be back at that 2007 peak before you know it. You can see that on the diagram here, we are looking at just about 5.5% on that prime business lending rate right now. That's the rate as of yesterday and last week and the week before, 5.5%. So Todd, what I'm thinking is that tomorrow, when the Bank of Canada comes out with its rate increase, it'll be 75 points from today. And then their next meeting that comes up in December, I wouldn't be surprised to see another 50 points. So
Wow.
that's more than 100 points, Todd. We're at 5.5 already. To me, it's just a matter of time until we're 6.5 at least uh, by New Year's Eve on our business prime lending rate. And that hurts our members. Our members are hurt by higher interest rates. So there you go. Those are the 5 slides, Todd, that I wanted to show to our members.
Wow. It's so interesting, Dr. Andersen, and I guess when I think about your earlier comment about front end loading or fast in as it relates to interest rates, any insights as to is it fast in and slow out, or what would you give in terms of your perspective of where we go in the future as it relates to interest rates?
Well, Todd, in the past, I think one of the things that's really important is the speed at which interest rates go up. And that last diagram, shows you that at the beginning of the year, we were 2.5% on the business prime lending rate. Now we're 5.5%. We're up 3 full percentage points on us. So such a quick increase has a shock effect. Now, it takes time for that to really show up in business conditions. But I'm just as worried as our members are about a recession risk. And in the past, recessions have caught us by surprise by happening sooner rather than later. So I'm worried that we could be slipping into a recession before the end of the year.
Wow. Wow. And when you think about, I'm just going to switch back to that labor dialogue and that we were having earlier on, Peter. And when you think about, job shifting that's been going on, this is a question that's come from one of our members. How much of that is actually impacting the labor market in terms of just people shifting jobs, and maybe that's all tied to the Great Resignation and kind of where people are at today, but there seems to be an awful lot of shifting, going from one company to another, kind of searching. Any perspective that you would have in that regard?
Well, I guess one perspective that I would throw in would be our amazing immigration policy, because the government has set a target of 400,000 net immigration for this year and for next year. And that compares with, that's about double what the normal level has been. So we do have big immigration, which is going to be supporting certain parts of the economy. And of course, we have a points system in Canada. And, I have heard, for example, in the construction industry, a number of people there in that industry who are saying that they hope the government will kind of fine tune its point system in order to get more immigrants that would be able to get involved in the construction trades.
Yeah.
So that is something that is really unique to Canada, that we do have such a overwhelming population inflow. And the thing that I've noticed, Todd, is in talking to home builders across the country, from Vancouver all the way to Halifax, the immigration impact is surprising them. Even though so many of the immigrants go to Toronto and Vancouver, it's still surprising people in Halifax, let's say, that they're getting this kind of an immigration impact on their business and on the job market.
Yeah. It's so interesting. And then when you think about immigration, obviously that's fueling the labor force. Any take on how many people have just left the workplace? What's your perspective on that?
Well, I think this is one of the things that we keep hearing about, Todd, is that people are retiring younger, and it seems to be part of the pandemic. It's one of these lasting influences that the pandemic has brought about. And we have changed our behavior in so many different ways. Just speaking personally, I never used an Airbnb before the pandemic. And now that's the first thing we think of when we go on a holiday. We think of the Airbnb app and where we might go. But I think that people have in some way reassess their life goals. And you're finding people, once they get into their 60s, they're starting to think about maybe their bucket list and enjoying life. And people with experience and skills are now harder to find because of this great resignation. And it seems to me, we always knew that the baby boomers were going to be retiring someday, but it seems the baby boomers are really retiring en masse. And that's not going to go away. I think it's going to mean for all of our members that automation and process changes are going to be all the more important.
Yeah.
One of the phrases that I've heard, Todd, is digital transformation.
Yeah.
Now, talk to your young techie friends about their views on digital transformation. I had to go onto the internet to get explanations of what digital transformation really means. But basically, it means turning your process upside down.
Yeah.
And moving away from the old way of doing things to new ways where you're data dependent and you're gathering actionable data that you can use to do things faster and more efficiently and with less workers.
Yeah, no question. You and I have had that conversation on several of our times together over the last few quarters, where we're talking about technology and how it's impacting the workforce. Maybe a loaded question for you, Dr. Andersen. I think I might know the answer here, but given the severity of our labor shortage situation that we're having today, is it possible we're already in a recession?
I wouldn't go so far as to say that until the unemployment rate starts to increase.
Okay.
Now, the job market, in a way, is a lagging indicator rather than a leading indicator. But the most recent news shows that the unemployment rate has actually declined from August to September. It has not increased. So we're still looking at historic low levels of unemployment. And that is basically the 800-pound gorilla in terms of that argument, that discussion, because I really don't think we can say we're there yet until we start to see some, diminishing demand for workers, until we start to see the job vacancy numbers come down. However, that's not to say we aren't there in some cases. And I would mention residential construction because home buyers are sensing that prices are collapsing in the housing market and buyers are holding back. And we're hearing cases that they're backing out of deals as well. And the problems in the housing market, of course, they're focused on areas and markets where housing has been at such unsustainable levels price-wise. But I have heard in some cases that in some markets that volume activity has come to a dead stop. Not in Calgary, but a dead stop in parts of Ontario in terms of certain products. And the products that are mentioned in the housing market coming to a dead stop or coming really hardly any activity, stacked townhouses. Now, what's a stacked townhouse? It's basically a hybrid between a single detached home and a condominium.
Sure.
That has ground level parking, Todd, because a lot of people don't like garage parking. So it's 850 to 900 square feet. It's kind of multi-story, low-level multi-story, 850 to 900 square feet, a stacked townhouse, kind of a hybrid, a new product designed for the entry-level, lower-income buyer. And things are really slowed down there. Really slowed down.
So when we think about that, Dr. Andersen, we think about housing pricing and obviously the slower starts that you're sharing as an indicator, a leading indicator. Where do you think we're going to go with housing pricing? Is it a natural expectation that prices are going to come down with the inflation rates and the things that we're dealing with?
Well, that's my expectation, is that we have more on the downside with house prices. The declines, Todd, I think are going to be more in the existing housing resale market, because in the new market for new homes, building materials prices are still way up there. They're still sky high. And in terms of a confusing world, Todd, many building materials products are sold out until early next year.
Yeah.
So that's the issue. And also, in terms of producing the things that go into building materials, I'm not talking about lumber, but I'm talking about other things. So many of them require heat in the production process, and natural gas is such a key component
Mhm.
of the industrial process in order to produce these components. You need heat in order to produce the steel, in order to produce whatever it is, the kind of building material.
Yeah.
And natural gas prices are being, of course, powered by what's going on in Ukraine.
Yeah.
And what happens this winter in Europe with natural gas prices, it's going to have some effect pushing them higher here in North America as well.
I wonder if we could. There's so many great questions coming in, Dr. Anderson. I know you're going to be busy at the end of this show because I'm not going to be able to get to all of them. But just since you brought up, which is a great thing, thank you, members, for jumping in. I'm curious though, as you drifted into obviously the crisis in Ukraine and Russia, and can we talk a little bit more about the indicators that you're seeing as it relates to? You mentioned natural gas. Anything else that is on your radar as it relates to imminent recession and kind of how that's going to impact North America, in particular Canada?
Well, it seems to me that earlier hopes that we had, Todd, that we thought that Victory Day in Russia was going to maybe give an exit ramp for Putin to find some way of getting some kind of a mutually accepted way out. It looks like this is going to be long and protracted. And it means to me that sanctions and countermeasures against sanctions are going to be with us really all through the winter and through next year. And Todd, that really means to me that inflation coming from the supply side, inflation, agricultural prices, chemicals prices, prices for oil and natural gas. This could all be so aggravated that interest rates don't just stop. Right now, the Bank of Canada's policy rate is 3.25%. And we're thinking that 4.5 might be the ceiling for the Bank of Canada. But if this Ukraine situation gets worse in terms of supply shortages, who's to say that 4.5 is the ending point? It could be 6. Who knows?
Yeah.
Who knows? So in a situation like this, Todd, what I'm saying to a lot of people, in terms of how optimistic you are and how pessimistic you are, I said, if you're too optimistic and you're wrong, it's going to cost you. Now, it'll cost you the other side too, Todd. If you're too pessimistic and you're wrong, there's going to be a cost to that. But balance that out. Which cost is going to be the greater? My own personal view is that if you are too optimistic and you're wrong by being too optimistic, the cost to me is the cost you want to avoid. So I'm saying don't be too optimistic in terms of inflation or interest rates or this war in Ukraine.
Yeah.
Hopefully, we're going to see that Europe gets through the winter, because it looks like their inventories of natural gas are enough to get them through the winter, Todd. But that doesn't mean the power is going to be on 24 hours a day.
That's right.
So if you are visiting Europe, don't get yourself in a hotel elevator between the hours of midnight and 4 in the morning.
There you go. Yeah, there's some good advice there for sure if you're traveling to Europe. I'm curious. You know, we're talking lots about recession and interest rates and what have you. And I know we don't normally drift into specifically, you know, government policies, but I am curious. There's a question that we have on the screen as well about the government's ability at various levels to spend their way out of getting us into a recession. We're hearing lots about that. I mean, your perspective?
Well, you know, Todd, I'm glad you mentioned that because think of the last time around. Think about 2008. And at that time, Ben Bernanke was the head of the Federal Reserve. We called it helicopter money. That's how we got out of the last great recession or the great financial crisis. It was helicopter money. And with an inflation problem now, you know, right in our face, it seems to me that we're not going to get helicopter money this time around to get us out of a problem if we get into one. And so that worries me, Todd, because that makes me think, wow, maybe this recession is going to last longer than anyone thinks. We're not going to get helicopter money because that's only going to make the inflation problem worse.
Yeah.
Yeah.
Yeah. No, I understand that. Again, when I think about our members, and another question that's come up, you know, obviously many of our members will, you know, be thinking perhaps they're thinking about evaluations of their businesses and the impact on their businesses relative to their own evaluations. And when you think about private equity money sitting on the sidelines, perhaps, how do you think all of this noise in the marketplace, whether it be interest rates, inflation, is going to impact business valuations and ability to perhaps have events, you know, with private equity firms or others?
You know, Todd, I hear what you're saying, but one of the things that I do look at a lot, I look at the stock market. And I like to keep things simple. So I basically look at the Dow Jones Industrial Average. I know that I should probably be looking at the S&P 500, or I should be looking at the TSX, or I should be looking at the Russell Index. I just keep it simple. That's too much to look at every half hour. So I look at the Dow and look at what the Dow has done in the last month.
Yeah.
It's been rebounding. It's been rebounding. So what kind of a message is that giving us? I mean, Wall Street is supposed to have a lot of smart people. And they also use a lot of artificial intelligence and, you know, computer IQ. And what's happening is that Wall Street seems to be saying that, look, they're almost done with rate increases. So that is kind of pulling the rug out of any warning that I might be giving myself, looking at economic data and looking at inflation news and wage settlements and so forth. So I don't understand the stock market, and I've always tried not to predict the stock market. I look on it as being a random variable, but my goodness, what a counter message we're getting in the last month. And even today, I mean, we're into earnings season. The tech giants are supposedly coming out with earnings reports today, later today, and this week. And the Dow is up. So,
yeah, there you go.
Go figure. Go figure. That's what makes it interesting, Todd, because there's
it does, depending upon what side you're on, right?
depending on what side you're on, exactly.
That's right. Dr. Andersen, I want to drift back into Canadian dollar, which is obviously on the minds of many of our members, in particular those that are doing business in the States as well. Driving forces behind the Canadian decline, you know, is it going to continue to drop? I mean, I appreciate that's a magic ball that you may or may not possess, but what's your take on our Canadian dollar and the implications?
Well, I don't think we can blame it on Ottawa. It's not like in England where you could blame it on what the government has been doing in England. I think it's the world. Canada is a risk currency. And if you are worried about the world economy, you don't want to be holding the Canadian dollar. You'd rather be holding the US dollar, because the United States currency is looked upon as the safest in the world. So if you are managing a global, or rather a country's investment fund, you would want to have your spare liquid cash into safe US investments. And what would be a safe US investment? It would be a short-term government bond. The US government is not going out of business anytime soon, and it's a safe haven. And so the US dollar is going up against everyone, some more than others. The eye catcher, of course, is the euro, where the euro is not worth as much as the US dollar right now. So that's a big change in just the last year. So anyway, I think that's it. I think that people are worried about China. They're worried about Russia, the Ukraine. They're worried about the world economy. And these currency moves are making it even worse, because the fact that other currencies are going down against the US dollar, that is a real financial problem for a lot of countries who have borrowed in US dollar terms. It's harder for these countries to pay the interest. It's harder for these countries to pay back the government bonds that they've issued in US dollars. It means that they themselves have to put in more tax increases and belt tighten in terms of keeping up with their debt obligations in US dollars. So
Yeah.
it's not good. It's an international problem. And the fact that Canadian dollar is weak, we're a risk currency, and we're also dependent on commodities, which are basically global economic risk assets. So,
Yeah. Hey, just as we kind of drift into more of this conversation, a couple more questions for you. But one is around your take on food price inflation, and as you think about what's going. I mean, even now with you got competitions tribunals looking at what's going on. I mean, what's your take? Why the disparity between inflation and food price inflation?
Well, I guess, yeah, first of all, just let me say how bad it is. The latest numbers for September show that grocery prices, this is for food purchased at grocery stores, not food purchased in restaurants, but food purchased at stores. It's an increase of over 11%, 12-month increase, not coming down at all. So it's really a hot issue. And I guess nitrogen fertilizer prices are a big factor behind this. And you kind of put your finger on the war in Ukraine for this lack of nitrogen fertilizer, a huge global shortage of the product. And that is tied in with natural gas, because you use natural gas in terms of the fertilizer production. So I guess the other thing would be transportation costs. Todd, it's built into something like milk and food and all of those things that have to be transported. And so my question earlier before the show started, what's the price of gasoline in Calgary? And you nailed it. You said $1.63 a liter, and I said as of this morning, I got $1.63.9. So you're right on with that. But the point is, hey, that's up 14% in the last month.
Yeah.
Because a month ago, it was $1.44 a liter in Calgary. And now it's $1.63, $1.64. That's a 14% increase in just a month.
Yeah.
So, I mean, that goes into things like food.
Yeah. Yeah, it's a scary number for sure for society when you think about that food inflation number that's rising. Maybe one last question for you, Dr. Andersen. When I think about our members today, that many of them, quite frankly, wouldn't even have gone through a major interest rate impact in their life, and certainly the inflation that we're experiencing today. What would you say to a business owner today in Canada? How do you protect yourself from the environment that we're in, given your history and you have been through many of these times in the past? So what would be your best coaching that you would give to our members?
Well, I guess, Todd, I used to shoot pool when I was in high school and college. I was never very good at it.
Okay.
But I remember one fellow that I knew quite well, and he was from Stratford, Ontario. And he said, Peter, it's not what you make that counts, it's what you keep. I kept sinking that white ball. I would take the high risk shot. And before I know it, I wasn't making anything and I was losing. I was not keeping my points. I was sinking that white ball. So that's a message. It's not what you make, it's what you keep. And get to the other side. The other thing, Todd, I would say would be to control your costs. Reorganize. Look carefully at things you can do in a less costly way. Productivity has been terrible at the national level. See if you can buck the trend and get more for the hour of work that your staff is spending. And reorganize with new technology. This digital transformation concept has got huge potential to it. So talk to your tech people about digital transformation, about changing your operational processes. You don't necessarily have to go out and spend big bucks on hard equipment, hard machinery and hard equipment, but you can do a lot of the soft changes with process change. So anyway, we always say, don't we, cash is king, have deep pockets and short arms.
Hey, there you go. What a great way to wrap things up, and great advice. I didn't see the pool analogy coming, but that was awesome. Thanks, Dr. Andersen. I just want to thank all members and chairs for attending. By the way, I saw Larry Burke made an appreciation note in the chat box for you, Dr. Andersen. So he's live on the line. So we appreciate your comment and acknowledgement. So again, chairs and members, thank you. Thank you for joining us today. Thank you for your participation in the Confidence Index. Please, in the future, when you see it come through in the member newsletter or through email, please engage and participate in that CEO Confidence Index. As you've no doubt heard today, that information is so insightful for so many of us and very, very valuable tool. I've mentioned it before, TEC Canada is cruising towards almost 2,000 members. That's pretty exciting for us, pretty remarkable, quite frankly. And I just appreciate your membership, appreciate all your support. I've enjoyed this conversation again with you, Dr. Andersen. It's always insightful. I want to thank you for coming on our show again today, and I'll look forward to talking to you again in a not so distant future.
Thank you for having me, Todd. Thank you very much. And thank you for your time, everyone.
Thanks, everyone. Have yourself an awesome week. Take care.